In a world of rapidly changing events, tensions rise and economies shift. Today, we dive into the most impactful news stories, highlighting significant geopolitical conflicts, economic shifts, and major policy changes. Here are today's top 10 stories you need to know. As we wrap up our news segment, there is a growing interest in the overall market trends as investors seek to understand the direction of the economy. Recent analyses indicate that while some sectors, such as technology and healthcare, show resilience, others, like retail and energy, are experiencing significant volatility. This divergence is influenced by a complex mix of global economic indicators, including inflation rates and geopolitical tensions, along with domestic performance metrics such as employment figures and consumer spending. Investors are advised to stay informed about these trends as they can significantly impact investment strategies and portfolio performance. Looking ahead, the focus will be on upcoming earnings reports and economic data releases, which will provide further insights into market stability and may influence investor confidence in the coming months. As the corporate earnings season kicks off, several major companies have begun reporting their quarterly results, revealing a complex picture. Initial reports indicate mixed performance, with some firms exceeding expectations while others have fallen short of forecasts. This earnings season unfolds against a backdrop of ongoing economic uncertainties, including rising inflation rates and supply chain disruptions that have impacted consumer spending patterns. Investors are closely monitoring these reports, as they can provide crucial insights into the health of various sectors, such as technology and retail, which are particularly sensitive to economic shifts. The implications of these earnings results could significantly influence market sentiment and stock prices in the coming weeks. As more companies unveil their reports, analysts will be keen to identify emerging trends and potential areas of growth or concern, particularly in light of anticipated interest rate changes by central banks. In international trade news, new trade agreements are being negotiated between several countries, aiming to enhance economic cooperation and reduce tariffs. These discussions, which gained momentum over the last few weeks, focus on key sectors such as agriculture and technology. The backdrop of these negotiations is the pressing need for nations to strengthen their economies amidst ongoing global challenges, including inflation and supply chain disruptions. As countries seek to recover from the pandemic's economic fallout, these agreements could lead to increased trade flows, fostering economic growth and innovation in participating nations. However, concerns are mounting regarding the potential negative implications for domestic markets and job security, particularly in industries that might face increased competition. As negotiations progress, the business community is closely monitoring the outcomes. If successful, these agreements could reshape the global trading landscape, potentially paving the way for a new era of international economic collaboration and interdependence. Economic forecasts released yesterday indicate potential challenges ahead for various markets, raising red flags for investors and consumers alike. Analysts have expressed concerns about the sustainability of the current recovery, particularly as inflation rates continue to rise and labor shortages persist in key industries. Historically, these factors have led to economic slowdowns, suggesting that while sectors like technology and finance have rebounded, others such as hospitality and retail remain sluggish, creating an uneven economic landscape. The implications of these forecasts are significant. They could affect investment decisions and dampen consumer confidence, potentially leading to reduced spending. Businesses are urged to prepare for potential volatility, reevaluating their strategies to navigate an uncertain environment. As we look ahead, the focus will shift to how policymakers respond to these economic signals. The upcoming fiscal measures and monetary policies will be crucial in determining whether they can effectively support growth and stabilize the economy in the face of these emerging challenges. As we examine the global economy, persistent supply chain pressures continue to disrupt various industries, severely affecting production and distribution timelines. Recent reports underscore ongoing delays and shortages, particularly in sectors heavily reliant on international shipping and essential raw materials. The context behind these challenges includes the lingering effects of the pandemic, which have strained logistics networks, and geopolitical tensions that have further complicated trade routes, notably in Eastern Europe and Asia. The impact is being felt across multiple sectors, from manufacturing to retail, leading to increased operational costs for businesses and higher prices for consumers. Companies are now seeking alternative suppliers and adjusting their strategies to mitigate risks associated with these volatile global supply chains. As we look ahead, the focus will be on how businesses adapt to these ongoing challenges and whether innovative solutions, such as localized production and improved inventory management, can emerge to stabilize supply chains over the long term. Effective adaptation will be crucial for economic resilience. In a shocking turn of events, KPMG has faced significant scrutiny and challenges that have sent ripples through the Big Four accounting firms. Reports from yesterday indicate that internal issues within KPMG could lead to major repercussions in the auditing and consulting sectors. This crisis is compounded by long-standing concerns regarding governance and compliance practices within the firm, raising alarms among regulators and clients alike. The firm's troubles have surfaced amid a broader landscape where accounting firms are increasingly held accountable for ethical lapses. The potential fallout may result in a loss of client trust, which can significantly impact KPMG's bottom line and market position. Furthermore, this situation serves as a cautionary tale for other firms in the industry, emphasizing the critical need for robust governance frameworks to avoid similar pitfalls. As KPMG navigates this challenging period, the focus will be on how effectively it addresses these internal issues and whether it can implement necessary reforms to restore its reputation and regain client confidence in the competitive landscape of accounting and consulting. In a significant development for the global tech industry, two Chinese semiconductor companies have raised approximately $1 billion through initial public offerings in Hong Kong. This event, which occurred yesterday, underscores the growing importance of the semiconductor sector in China's economy, particularly in light of ongoing global supply chain challenges. Investors have shown strong interest in these IPOs, reflecting confidence in the potential for growth in the tech sector despite geopolitical tensions. The background context reveals that the semiconductor industry has become a focal point in U.S.-China relations, with both nations vying for technological supremacy. The impact of this IPO boom could be substantial, as it may lead to increased investment in domestic manufacturing and innovation within China. As these companies go public, they will likely face scrutiny regarding their international partnerships and trade implications. Moving forward, analysts will be closely monitoring how these developments affect the global semiconductor landscape. In financial news, the stock market has experienced a significant decline, driven primarily by losses in major technology stocks. As of yesterday, the Nasdaq Composite Index fell sharply, leading to a broader market sell-off that has investors on edge. The catalyst for this downturn appears to be a combination of disappointing earnings reports from key tech firms, including major players like Apple and Amazon, and rising concerns about inflation impacting consumer spending. This inflationary pressure is causing consumers to tighten their budgets, which could adversely affect tech companies reliant on discretionary spending. Analysts have noted that this trend represents a shift from the previously bullish sentiment surrounding tech stocks, which had been buoyed by strong growth during the pandemic. The implications of this decline are concerning, as it could signal a broader market correction that might affect various sectors. Investors are now reevaluating their positions in the tech sector, seeking safer assets as uncertainty looms. In the coming days, market participants will closely monitor the next round of earnings reports and economic indicators to assess the potential for recovery or further decline in the tech market. The latest economic data reveals that inflation in the United States has surged past the 4% threshold for the first time in 3 years. This alarming statistic was confirmed in reports released yesterday, showing that the Federal Reserve's preferred inflation gauge, the Personal Consumption Expenditures Price Index, rose from 3.8% to 4.1% in May. This sharp increase has raised concerns among policymakers and economists alike, particularly as it surpasses the Fed's target rate of 2%. Contributing factors include rising gas prices, which have skyrocketed due to geopolitical tensions and supply chain disruptions that continue to plague various sectors. The implications of this inflation spike are far-reaching. Consumers will feel the pinch as everyday costs rise for essentials like food, housing, and transportation. Businesses may also face increased operational costs, which could lead to reduced hiring or wage growth. The Fed may be forced to consider interest rate hikes to mitigate the economic fallout, a move that could slow down growth. As the ongoing debate intensifies on how to balance inflation control with economic expansion, the Fed's upcoming meetings will be critical. Decisions made in these meetings will significantly shape the nation's economic landscape moving forward. As tensions in the Middle East continue to escalate, a new round of military actions has sparked international concern. Over the last 24 hours, reports have surfaced of increased hostilities between regional powers, particularly involving Iran and its neighboring countries. This escalation is marked by military skirmishes and rhetoric that heightens fears of a broader conflict. Background context reveals that these tensions have been simmering since the U.S. withdrawal from diplomatic negotiations in 2021, which left a significant power vacuum. Various factions, including Iran-backed militias, are now vying to exploit this instability. The impact of this escalation is significant, with oil prices soaring as markets react to the uncertainty surrounding supply chains. Investors are closely monitoring the situation, as any prolonged conflict could disrupt global oil supplies, leading to economic repercussions worldwide. In response, major world powers, including the United States and European nations, are calling for renewed diplomatic efforts, yet skepticism remains high regarding their effectiveness. Experts warn that without immediate intervention, the situation could spiral out of control, affecting not just the region, but the global economy as well. Looking ahead, the focus will be on whether diplomatic channels can effectively address these rising tensions and avert a potential military confrontation. Thank you for joining us for today's News Roundup. Which story shocked you the most? Let us know in the comments, and don't forget to like and subscribe for more updates.